Hello everyone, this is Corey Mitchell with TradeThatSwing.com, and this is your very quick stock market outlook for the week of May 22nd. You can see my recent stock watch lists if you're interested in seeing the trades that I'm watching to see if they set up in these articles here. And this outlook you can always find just on TradeThatSwing.com. It'll usually be on the first page of the home page because it gets updated each week. And let's get into how's the market looking. I look at 4 different U.S. indices because they each look at a little bit different segment of the market, and they're acting very differently right now. Then I also just have, for interest's sake, a few other ones up here: the Canadian, gold, Bitcoin, and Ethereum, and one other one that's performing well. So let's check out those. And NASDAQ, just in a super strong uptrend, not much to discuss there. It's doing great. The S&P also in an uptrend, a little bit weaker. You can see these are pretty much covering the same time frame, and here we just have these really big higher swing highs. We started out that way in the S&P, but you can see we're just kind of barely getting to our early 2023 highs, where the NASDAQ is way above it. So the NASDAQ is stronger. The S&P is still in an uptrend, but it's just kind of more of a slightly angled uptrend as opposed to a really strong uptrend. The NYSE composite, this is the sort of broadest measure of U.S. stocks because it encompasses all sorts of stocks that are different sizes, different prices, different industries. And it's not doing as great. You can see we had this major drop to a lower swing low, so we can't call this an uptrend anymore. We're more just like whipsawing sideways. Or could even make the argument that we're in a bit of a downtrend at the moment. We had this really big drop here, and we haven't quite recovered back even to those highs from March, swing highs from March. The Russell 2000, smaller companies also, it's hanging out near its yearly lows, so much different story compared to these. So what does that tell us overall? It tells us that the indices are mixed, that we have certain stocks that are doing okay, and we have a lot of stocks that are not doing okay. So if you're going to trade, it's going to be highly selective, and expect a low win rate out there. If you're deploying a lot of capital, expecting a lot of stocks to move up, that's not really happening. If you're in the right spots, it can be good, but if you're in some of the wrong spots, like these smaller caps or just kind of the average typical stock, it's probably not really doing too much at the moment. The Canadian index, kind of like the S&P 500, we're in a slight uptrend, but we came all the way back to these lows. We haven't quite made it back to the highs yet, so this could almost just be a big range as well. It is cut off over here where we had this really strong up move, but just kind of ranging at the moment. The French index, this is QQQ ETF, one of the strongest in the world, just a super strong uptrend through 2023 and prior. Gold was strong, broke below these lows, so this would have to recover very quickly to indicate this is a false breakout below these lows, and we need a really sharp rally. But as it stands right now, that's not a great sign that it took out these lows. Same with Bitcoin, took out these lows, but it held very quickly. Same with this, very quickly, bounced back the next day. So that's what I call an inflection point. We're basically here to see, is this going to continue lower, or is this our little turning point and we start heading back up? Same with here. If we consolidate for a little bit or whatever, we're either going to drop or head up. So those are interesting ones just to keep on the radar as well. So this basically just says what I talked about. And if we focus in on the S&P 500, I like to look at what I call the market health indicators. So these give us a sense of how the overall market is doing. And I see my labels got cut off, but this is how many stocks are above their 50-day moving average. So the orange one is the S&P 500, and we can see about 50%, 49.8% of S&P 500 stocks are above their 50-day moving average. 48% of all U.S. stocks are above their 50-day moving average. It's generally much easier to make money on the long side when more stocks are above their 50-day. It's just a very crude measure of how many stocks are in a short-term uptrend. And so we're right on the cusp there. We're hanging out. This isn't a great number. It's not a bad number. It's okay. Volume, not super important to me right now. This just says how volatile is it. This is the daily average movement of the S&P 500. A lot of times I have this zoomed in to more recent data. I included this prior uptrend just so that you can see the difference between an uptrend and a downtrend. So if we look over here to an uptrend, you have the occasional day, maybe once every couple months where you have a negative 2% down day. Then you get to over here and you have multiple 2% down days. Multiple ones every month, every couple months. And we're getting back more to uptrending behavior where we're starting to see these smaller values. And I've put lines in at plus 1.5% and minus 2%. And the upside doesn't really matter. It's more that downside one that we want to watch. Are we still getting really big drops during the day? That's usually a bad sign. And we're not getting those right now. So we're getting back more to this type of uptrending behavior. So that's a good thing in my mind. It's kind of hard to see. We've flatlined out a little bit. There was a positive divergence, meaning the NYSE advanced decline line. This is the NYSE advanced decline line. It's just advancing stocks versus declining stocks as a cumulative number. And we had made a new swing high here relative to earlier in the year. When that happens, it's usually a very good indication that the S&P 500 is going to follow through and also make a new high. Because it hadn't, we made this high back here and the S&P was still hanging out below its prior high over here. We have now reached that high, so that positive divergence is done on the NYSE advanced decline line, and we're just kind of flatlining. So now it's kind of back to neutral, and kind of like what we're seeing in the other indices. We have some that are doing okay, some that are not doing okay. So this is pretty representative of that. This is total up volume versus total volume. Just says how much buying enthusiasm or selling enthusiasm there is in the market. When we have these really big spikes, it shows buying enthusiasm. When it's a really low number, it's big selling enthusiasm, or there's not a lot of buyers. And really, we only care about this really top line and this bottom line. And we have not had any values that have reached that in a long time. So this is 90% up volume. That means 90% of the volume that occurred that day occurred in stocks that were moving higher, or that finished up on the day, you could think of it as. So we haven't had any numbers like that, and we also haven't had any really low numbers. So this one, really no results at the moment, not giving us much information. So these a little bit mixed, or right on the cusp again, which is, I guess, what we could expect based on looking at the indices. Like we said, you have some that are really strong, you have some that are really weak. So when you think of overall stock market health, what does that tell you? It's okay. It's not great. It's not horrible. It's just okay. The real question is, how much capital do you want to employ in that environment? I have been very selective with my capital. I have a few positions out there, but I'm definitely not loading up. If you're going to load up in really good conditions, you would have to see all these health indicators good. You would need to see all the indices moving up. That's really good market health. And that's when you want to have all your capital deployed, maybe even utilizing some leverage if you're into that. And right now, we're not quite there. So you probably want to be 50% or less of your capital deployed. Sectors on the move. This one, not too much to discuss here. Communication services and technology. Best performance on the week, best performance on the month, best performance over the last 3 months. That's, if you're going to focus on somewhere, that's probably where you want your money in right now. What else am I doing? Well, I'm always day trading, and that provides a more steady stream of income, I guess, because there's setups that occur every day, as opposed to swing trading, which is more of this, we're deploying some capital. Okay, we're not deploying any capital. Okay, we're fully loaded up. There's more of this like ebb and flow to how we deploy our capital, simply because we're more exposed to overall market conditions, whereas with day trading, we can, we see a setup, we can plow in, we're going to be out in 5 minutes. So it's a lot less to do with market conditions. And in terms of the swing trading, like I said, I'm willing to deploy some capital if things are good. We're right on the kind of cusp of being good, and that's okay for me to trade in, but I'm not loading up by any means. If all of this seems a little crazy, there's also the option to just passively invest. I do this in one of my accounts. I just buy the same ETFs over and over again every month, and regardless whether the market's moving up or down. And it's not going to produce quite as big of a return as swing trading, but it's a whole lot less work. So if that's something that you're interested in, you can click on that, or you can also just click on this little passive investing ebook link on the site. So that's it for this week. Have a great trading week out there.